September, December 2019, question number 4. This is the last question of this paper. I have discussed question 1, 2, and 3. So if you haven't checked my first 3 videos, please go and check them. And so this is question number 4. As you can see, this question has some ratios. You can see return on equity. Then we have special purpose entity. We have some kind of transactions. Let us read the requirements first. So discuss the reasons why an entity may choose a particular accounting policy where an IFRS allows an accounting policy choice, and whether faithful representation and comparability are affected by such choices. Now when you read this question looks a very, it's like too much of this requirement is asking you of too much, right? So in this situation, what you have to do is don't read this question sentence, this kind of requirements where there is so much of requirements in one go. Otherwise, you will not understand. Break it into pieces and read. For example, now I'm reading it. Discuss the reasons why an entity may choose a particular accounting policy where an IFRS standard allows an accounting choice. So till here I'll be reading. This is one requirement. We know that IFRS has a flexibility where sometimes like depreciation or stock valuation, they allow a choice. We can use a reducing balance method or straight line basis method, or even for stock valuation, FIFO or FCO, right? But a particular company might choose a particular method. Why is that? So that is the question. That is the requirement asking you. First part of the requirement. Second, and whether faithful representation and comparability. So there are two things. Is it going to affect faithful representation, the choice of the company, and comparability? So two things you have to answer. Coming to part B. First part of B, discuss the usefulness to investors. So this is a theory question A, right? Part B, let's read. Discuss the usefulness to investors of ROE ratio. You will be tested ratio, right? Not always, but you can be. So you have to be prepared with all kind of ratios, and the formulas will not be given to you in the formula sheet. So you have to memorize the formula. What is ROE? What is the formula? ROCE, operating profit, or gearing margin, all those things. So discuss the usefulness to investors of ROE ratio and its component parts provided above, and calculate this. So this has a lot of requirements in one. 3 or 4 requirements is there in part B for 5 marks. First is usefulness to investors, then its component part also, then you have to calculate ratios for the year ended 31st December 2005 and 6. The ratios you have to calculate. This calculation should be based upon the information provided in the table 1. So they have clearly given you which table to use. 5 marks. Second part is where you have to do a lot of things because it's worth 12 marks, and if you see here the professional marks are also here. The 2 professional marks was asked in question number 2 in section A, and the other 2 professional marks are asked in question number 4. So this is how your professional marks will be divided, 2 into question number 2 and 2 in question number 4. Okay, so that means the way you write, the format of your writing, the tone of your writing matters a lot to get those 2 professional marks. You have to be very careful when you write this type of questions where you have professional marks. You just cannot write anything. Okay, so let's read what is for 12 marks. Discuss the impact that the setting of the SAPs and the miscellaneous transaction have had on ROE and its component part. Given these considerations, adjust table 1. You have to adjust the table 1 and recalculate ROE for 2006, whereby making it more comparable to ROE of 2005. You have to make it more comparable for 12 marks. Let us read. So background, definitely you have to read first. Guidance. Companies considering the financial results for year ended 31st December 2006, the industry places great reliance on the return on equity as an indicator of how well a company uses shareholder funds to generate a profit. Return on equity analyzes return on equity in order to understand the fundamental drivers of value creation in the company. It is calculated. The formula has been given to you, right? Guidance. Company uses year-end equity and assets to calculate the calculate the ROE. So they have given you the net profit before tax sales as an equity for both the years. Now special purpose equity entity. What is it? Okay, so let us read the whole case study. Okay. During the year end 31st December 2000, Guidance Company stated that it had recognized its assets and set up a SPE. Guidance Company transferred property to SAP at its carrying amount of 50 million. So it has transferred property. The carrying amount is 50 million, but had incorrectly charged revaluation reserves with with this amount rather than showing the transfer as an investment. So what they did was that 50 million they have put it in revaluation reserve instead of showing as an investment. The property was the SAP's only assets. However, Guidance still managed the property, and any profit or loss relating to assets of entity was limited directly to Guidance. Guidance had no intention of consolidating the SPE. Okay, now let us go to the last. Guidance Company has bought back 25 million shares. It has bought back 25 million shares of worth for 1.2 per share during the year end 31st December 2006 for cash and cancelled the shares. The transaction was deemed to be legal. Guidance Company also raised a loan capital for the first time during the year end 31st December 2006. It also raised a loan capital. Everything is on 31st December 2006 of 20 million in order to help with the buyback of the company's share. Guidance has purchased 25 million interest in an associate company. On 1st of July 2006, the date is very important because year end is 31st December 2006, but in between the year 1st of July 2006 they bought an associate for cash. The investment had cost how much? 15 million, and his associate had profit of 32 million in the year end 31st December 2006. Guidance accounted for the purchase of associated correctly, so no need to change that. It is correctly done. All of this transactions has been accounted for in the financial information for the year end 31st December in table 1. Right, in the table 1 it is there. Now so, this is the table 1. This is your table 1. Now let us go to 8. So management intent and motivation will often influence accounting information. However, corporate financial statements necessarily depend on estimates and judgments. Financial statements are intended to be comparable, but the analysis may not be most accurate way to judge the performance of any particular company. This lack of comparability may be due to different accounting policy choices or deliberate manipulation. So now 6 marks, it's right. So first part A should be the most easiest for you to answer and get the full mark. Let us read the answer. Where an IFRS standard allows an entity an accounting choice, the financial statements will be influenced and affected by that choice. Yes, you know, wherever choice is there, it will be affected. Financial statements will be affected. So management's intent and motivation will influence accounting information. The accounting policy chosen can be driven by self-interest. Yes. Why? One is self-interest. They might have some self-interest to have that particular accounting policy by a wish to maximize the interest of shareholders or by a wish to provide information. Yes, maybe they want to maximize the interest of shareholders. Where there's a flexibility when applying IFRS standard, the financial statements can become less comparable. Another issue is it can become less comparable where there's a flexibility, because one company will be applying let's say reducing balance method of depreciation, the other one will be doing straight line basis, so it's hard to compare, right? Isn't it? Entities may use the financial, see this you can even write from your general knowledge also, your common sense also. Still I'm reading this answer for few of you to show how to answer a theory part, fully theory part, without no IFRS, no numbers and all, because I know how hard it is to answer theory part. I have been in that condition. So entities may use the financial choice to increase earnings. One reason, they might want to increase earnings, that's why they might choose a particular thing, or they might want to manipulate accounting figure in order to influence the contractual outcomes which depend on the accounting figures. So sometimes you get bonuses, year-end bonuses based on your sales. If they tell that turnover, if you can increase by 5%, 10%, like that figure, some figure they give, your bonuses are linked to that. So and you know that you are not able to increase it. So what do? You try to manipulate the figure and increase your revenue just to get that bonuses. There You play because you know there's a flexibility. So you can just use the accounting policy, change it for your own interest. Next, accounting choices exist to provide companies which operate under different business models and with the option of utilizing an accounting method which best represents their operation. Another reason is why the choice is there, because each company is different. For each company different, it applies differently. Any accounting choice in IFRS standard should still result in the financial statements being faithfully represent. You have to talk about faithful representation and relevance. Remember that. These two concepts you have to talk when you're talking about accounting choice. Even though there's a choice in IFRS, still financial statements have to be faithfully represented. This has to be there. If this characteristics is not there, then you cannot choose that accounting choice. If it does, it helps to show something faithfully represented, then it's fine. Otherwise, you cannot. A faithful representation means that to the maximum extent possible, the financial statements are complete, neutral, free from error. These are the definition of faithful representation. A faithful representation is affected by the level of measurement uncertainty in the financial statements. See, if you have an area where it is highly uncertain to measure something, better not to include it because it's very uncertain. It is not representing something faithfully. Comparability. Now you have to talk about comparability. Is one of the four qualitative characteristics which enhances the usefulness of information. We all know. I hope, I'm assuming that you all know what are the four qualitative characteristics which enhance the usefulness of information. See, the two, faithful representation and relevance, are the fundamental characteristics, but the enhancing the qualitative characteristics, there are four. Out of the four, one is comparability. You don't have to talk about other three. Don't make the mistake of talking about other three. This is the mistake where candidates go wrong when you are asked to write a theory part. You start writing all the four qualitative characters, which is not required because specifically they told faithfully represented and comparability. So you only have to talk about comparability. That's it. So thus accounting information would be more useful if it can be compared with similar information from other entities or from the same entity, right? Isn't it better where you can compare? However, it is extremely difficult for entities to have comparable financial information. Yes, because one is using that method, the other one is using different method. So comparability is crucial to improve financial reporting quality, but it can be argued that comparability is made more difficult by the fact that board allows entities to choose between alternative measurement bases. Environmental, economic, political, cultural, operational differences could be solved with the existence of accounting choices and standards, but these choices could be at the cost of comparability. Yes. Especially if there are internal and external factors influencing the reliable disclosure of an item. A faithful representation might lead to comparability because it should reflect the characteristics of the asset or the liability. Coming to part B. Right? So let us read the requirement of B again. Usefulness of this one to IRR, component part, and calculate ratios. So before we calculate ratios, let us write the usefulness of ROI, and mind you, some of this usefulness you can even take and memorize for your future answers if you get such a question again. So the return on equity ratio measures the rate of return which the owners of issued shareholders of a company receive on their shareholders in terms of profitability. Right? I'm reading fast because this all is easy to understand. You also can read and understand it. So I don't want to waste so much of time on this. That's why I'm reading it fast. I hope you people will not have an issue with that. ROE signifies how good the company is in generating profit on the investment it receives from its shareholders. This metric is especially important from an investor's perspective. So when you have to talk how useful it is to the investor, first at least one or two line write about the ROE, what it measures, how useful it is, right? Then you talk in terms of investors, how useful it will be to the investor. But first you have to say what it measures. Don't just say ROE is good for investors because and all. Don't start like that. So this metric is especially important for investors' perspective as it can be used to judge how efficiently the firm will be able to use shareholders' investment to generate additional revenue. That's why it's important for investor. Now, net profit margin tells how much a profit a company makes on every dollar of sales. Asset turnover, see each ratio they're explaining, whatever is given at table 1. One is net profit margin. The other one is asset turnover. Right? When you tell asset turnover, you can give the formula also. Give formula also. Each time you write a ratio and explain, write a formula. In bracket, you can write asset over sales ratio, measure the value of a company's sales or revenues generated relative to the carrying amount of its assets. Asset turnover ratio can often be useful as an indicator of efficiency with which a company is deploying its assets in generating revenue. Equity ratio, third ratio, indicates the relative proportion that the equity is used to finance a company's assets. The equity ratio is a good indicator of the level of leverage used by a company by measuring the proportion of the total assets which are financed by shareholders as opposed to creditors. Higher the equity ratio means what? That means most of your assets are financed by shareholders, not by the outsiders, not by the finance parties, not by the creditors, lenders, right? So your gearing level is low. So now after you have explained here, you can write, give the ratios, okay? So first is, if you can see here, net profit before tax. So here from looking at this, is not clear with what are the margins, but it's common sense that net profit margin you can find out because you are given the net profit also, you are given the sales also. So net profit divided by net profit before tax divided by sales will be your net profit margin for 2004. That means 30 divided by 200 and 38 divided by 220 will give you the net profit margin as here, right? 15 and 17.3. You can see that it increased, which is good. Slightly increased, which is good. 2.3% it increased. You can even show an arrow like this. Now let's go to the next ratio. So here you are given at least four ratios you can give. The next is asset turnover, because you are given the sales also, you are given the assets also, right? So the next is asset turnover, as you can see from here. This also increased, which is good, right? Asset turnover, I hope you know the formula. Make sure that you write the formula also. It is 200 divided by 250. Sales over assets. Next, equity ratio. What will be your equity ratio? It will be your what? This is your equity ratio. Assets over equity. So assets over equity. 250 divided by 175 and 210 over 110. So if you see here, this also increased equity ratio, which is again a good sign. Now come to the return on equity, the last ratio. You are given the equity, so you can find the return on equity also. So how will you find the return on equity? The formula is given here. Just see up. Net profit before tax divided by sales into sales of assets into asset over equity. Right? So in short, what is net profit before tax divided by sales? This is your net profit margin. Multiply by what is sales divided by assets mean? Asset turnover, right? Okay, I will write 80 asset turnover. Multiply by asset over equity ratio. EQ. Equity ratio, ER. So just multiply the three ratios, you will get this thing. Just multiply this with this with this, the three ratios. First three ratios multiply and get the return on equity. Right? 17 and 38, which is very good. It increased drastically. Doubled, more than double. Right? Now, what is the last part? So discuss the impact on setting up of SAP. So this and the transactions. Okay. So here also you have to use your ratios and the table 1. Which one you are using here? Which IFRS? IFRS 10. Consolidated financial statement states. What does it state? That an investor controls SAP when it is exposed. Why you talk about IFRS 10? Because you have purchased an associate. Whether you have purchased an associate or a subsidiary, you have to refer to IFRS 10, because here only it says the rule whether you have to consolidate or not, because they decided they will not consolidate. So we'll check with this IFRS 10 whether it is allowed or not. States that an investor controls SIP when it is exposed, has rights, variable returns from involvement with SIP, and has ability to affect those returns to his power over the SIP. All these are copy paste of IFRS 10. When you read IFRS 10, this will be there exact as it is. There is no change of words. This revised definition of control focuses on the need to have both power and variable returns before control is present. Power is the current ability to direct the activities. So you are giving the definition of power, which significantly influences returns. Guidance obtained. Now you are relating it to the company. It obtains the reverse from the assets transferred and is exposed to the risk. By transferring their assets, asset turnover ratio will be significantly larger. However, they should be consolidated by guidance in his group financial statements, and the properties included in assets and charge eliminated from revaluation. You have included it in revaluation reserve, right? You have to eliminate from there. In a single entity, in the single entity financial statements, the latter will increase the shareholder equity. So when you eliminate from shareholder reserve, right, it will increase the shareholder equity, and this should be consolidated in the group financial statements. Now let's go to this. So a major concern about using ROE is when a company buy back its shares. Yes, there's a major concern when you're using this, when you're buying back shares. It decreases the equity. Why? Because when you're buying back shares, remember, it decreases the equity. Decreases the equity. What happens when you decrease the equity? On the statement of the financial position, and in the case of guidance, it's cash and consequently its total assets. Right? So as a result, the performance matrix, asset turnover and ROE will be affected. Which two will be affected? Asset turnover and ROE. Return on equity, you say, because your return on equity, in that formula we have equity. Asset turnover also we have equity. Your asset will reduce because your equity is reducing. So asset turnover will fall down, ROE will get affected. So the ROE figure would produce a misleading indicator as to how well a company is being managed, as the equity portion of the ROE shrinks and the ROE matrix gets larger. ROE calculation can become meaningless if a company regularly buy back its shares. So if you're regularly buying back share, what happens? ROE increases because your equity is in the denominator. It shrinks. So when something becomes smaller and smaller, the denominator, the number, the answer becomes bigger and bigger. So looking at ROE, you think it's very big, it's good, but actually it's not the fact, right? Then ROE becomes meaningless if you regularly buy back its shares, and thus as a result there may be better metrics for investors to use, such as PE ratio. You can even suggest some ratio in this condition. Such type of questions where one ratio is not good, it's better that you, from your knowledge, refer or recommend another ratio, such as PE ratio. It's better to use this kind of ratio rather than return on equity ratio under this condition where you have frequently or regularly you buy back shares, because it will inflate your ROE, not because ROE actually improved, because your equity fell down, denominator reduced, right? Just see here ROE, the formula, if you forgot. So here is your equity, it falls down. So if it falls down, this will increase. Understand that relationship. You can even mathematically prove that. Just put some number, reduce number, and see how your ROE increases. Now, guidance has raised loan of 20 million, right? From the case study we saw, I have even highlighted also 20 million loan they have raised during the period, and this amount will not be included in the ROE calculation because ROE is based on assets as opposed to net assets. Exactly. ROE is based on assets. It is not based on net assets. If it was based on net assets, then the loan you can reduce from assets. Therefore, this loan will not be included in ROE. So on one company may have a higher ROE than another company simply because it finances business through loan capital rather than raising equity capital. It can be argued that ROE is not a meaningful measure of performance as it takes no account of the amount of debt involved in creating profits. Exactly. It takes no account of the amount of debt. Therefore, this again is not a good measure of performance. Therefore, return on capital employed may be a better. See how they are suggesting. First, they told PE ratio. Now they are saying return on capital employed will be a better measure for guidance. So this how your answer has to be, and it's in one line in a separate paragraph, one line only. Next paragraph. Guidance has included the profit from the purchase of an associate in the current year's figure. Yes, they have told it that whatever associate they have purchased, the profit is included in the current year's figure. So if the share of the result of the associate were excluded, this would allow guidance profitability to result exclusively from guidance asset base. Exactly. It could be argued that the full value of the company's reported profit, including the associate, could distort the analysis of guidance performance as compared to the last financial year. Yes. If you take the associate's profit out of it, profit reduces. Then when you compare with the last year, it becomes a big difference. So there is no need to adjust for the original 15 million investment. What was the investment? The cost of investment 15 million. So they are saying there is no need to adjust for the original 15 million investment in associate. Why? Because one asset is merely being replaced by another, but the total assets remain the same. It is just one asset is being replaced, but it remains the same. Total assets remain the same. Therefore, you don't have to adjust. Okay. Here. So here, if you see, each one they have talked about loan capital, then they talked about this associate, then now we are going to, what are we going to do? Adjusted amounts, right? All these are taken from where? 38, 220, 210, 100. It is taken from where? Which? Table 1. All this amount, 2006. All this amounts they are taking as it is. Next, what are they doing? Assets and equity 50 million. And how much shares they are cancelling off? To know that, let's go 25 into 1.2. So 25 into 1.2 is 30 million, right? That's why 30 million shares are cancelled. Associate is 4. How associate is 4? Let us see that. %25 of interest in associate for cash. Something has to be done. Okay. So if you take it this, it will be deducted. So if you see your net profit before tax falls down 34, sales remains the same, your asset, it increases, right? 50 and 30. Because when your shares cancel, assets will increase. Equity, right, will increase to 176. Now you can calculate your ratios. So this ratios you can take as it is from before, you have calculated it previously, and this also adjusted and unadjusted. So unadjusted you have already calculated before, right? Now you have to do adjustment. How will you do the adjustment? Just the figures are changed, you have to use these figures now. That's it. So if you can see now, isn't it better to compare? Because it's very similar. Just see, not much difference, but before it was much difference. Net profit margin was much higher, asset turnover was much higher, equity ratio was higher, ROE was much higher for the unadjusted. We'll come to this associate part, how it's for, okay? But first we'll read this and finish it off. It can be seen that if the impact of the transaction they paid were eliminated, then there has been a significant reduction in ROE and its component part. And the buyback of shares and the purchase of associate were legitimate transactions but they were eliminated in order to determine comparative metrics. The raising of the loan capital was also legitimate but was not adjusted for because ROE is based on assets, not net assets. The transfer of assets to SOP was contrary to IFRS 10 and would have been reversed in any event. Although financial metrics are intended to enable comparisons between companies, the relative performance of any particular company can be affected by transactions both acceptable and unacceptable under accounting standards. Right? So now it's done. We are done with question 4 as well, and please don't forget to check the marking scheme. I haven't included the marking scheme in this video, but the marking scheme is there at the end of the answer. Your mark at the end of the marking scheme, after all the 4 questions are answered, the marking scheme is there. How much mark is there for each is very important to know it. Otherwise you don't know how much to write and what are the main areas to cover. So now let us go to the associate. So it is 25% of 15 million, which is 3.75, which is rounded to 4. If you see here, because associate is 25% and the cost is 15 million, so 25% of 15 million is 3.75, which is 4. Right, rounded up. That's why they have got 4, which is actually 3.75. With this, I finished question number 4, and we have finished this September-December 2019 paper. I will be coming up with all the papers of SBR. I'll be solving one by one. So don't forget to subscribe to my channel so that you get the updates, notifications on my latest videos, and also hit that bell icon so that you receive the notification. Thank you and take care.